in Houston right now, walking our new 56-unit crazy property here. It starts down there. $1 billion man.
Shaun Riney, my man, welcome to the podcast. One of the top commercial brokers in Brooklyn, and what I just found out, some deals in Long Island as well, stepping into my territory. Please introduce yourself.
What's going on, Alone? And thank you for having me. Happy Friday. Hopefully we get through this. The brain is starting to get foggy, but thanks for having me.
It's a pleasure, man. It's a pleasure. I'm happy you drove out here in your monster truck.
Yeah. Well, bonus depreciation. It's got to be over 6,000 pounds, right?
That's
had to go big.
That's it. The moment you got here, we started talking about taxes.
Do not spend money you cannot deduct. Just golden rule.
That or you can make income,
Correct,
right?
Correct. But the combination of both is the ideal. But
yeah.
If you're gonna spend money, that truck is that was a good offset this year.
That's
I'm
awesome.
gonna have to buy another one. We'll see.
So Shaun, you've been in the real estate business since 2009. I read your bio before you came in. Very successful commercial broker. You've done a couple billion in transactions. What do you think sets Brooklyn apart from the rest of the other markets out there?
Well, Brooklyn, I got kind of fortunate. One, just to take a step back, I moved to New York City from Boston fall of 2008 in September. So I got my first lease, 54th and 7th Avenue, and Lehman Brothers hit like 3 weeks later. I actually saw the people walking out with boxes. I didn't really know what it meant at the time. But I was kind of fortunate timing. I also made the fortune happen. You just kind of stay in one seat and eventually things take care of themselves. But in 2009, 10, 11, 12, obviously everything kind of stopped, but it was also the time period that Brooklyn started to get discovered. So I was kind of fortunate to just be in a market that, was kind of getting more and more discovered. And I guess New York City neighborhoods are always getting discovered, but that really took off like pari passu to my, trajectory and growth. What sets it apart? Just like New York City, it's so diverse and there's just so much nuance to it, and the neighborhoods all offer something different. I think the quality of life, personally speaking, is a lot higher. I personally live in Williamsburg for the last 7 years. Can't seem to leave it, partly because, and I am a big person on variety and novelty, but it's always changing. There's new restaurants, new nightclubs, new music. It's hard to leave a neighborhood when the neighborhood around you is constantly changing. It's hard. I don't get sick of it.
And you're very outdoorsy.
Yeah, I think I love the city life. I think life is all about seeking contrast. So for me, it's country, city, city, country, beach, ski mountain. You got to kind of mix it up. But
and where do you keep that truck?
I keep that truck in the underground of 25 Kent Avenue, which is still a vacant office building in Williamsburg, more or less. And I should probably just get like a 10-year long-term lease, because I know as soon as they fill that up, my rent's going to get jacked.
That's hilarious.
Yeah.
That's so funny.
But yeah, that's the truck that stays out in Montauk most of the time. It's not maneuverable in the city.
Nice. Hey, you bring this sort of sophistication into the brokerage world. I'm just picking up on it now. I've heard a couple of your videos over the years, and as we talk, I can tell you're very well educated. I think I read you went to BU, right?
Didn't learn anything there other than how to rent apartments and build a fraternity.
Oh, very nice.
Yeah.
At least
poli
better than
sci
nothing.
major. What did I learn? About Socrates. I don't. It was more. The BU education was I started a fraternity, built the base, made all the fraternity members basically rent apartments for me. And in Boston, it's so easy to rent apartments if you're just in the game, because everyone has to have one by September 1st. They all come into the market at the same time, and everyone's got their co-signers. So it's kind of like a New York market, except everyone is September 1st. So
I see.
It gets really hectic.
And how does this sophistication help you in the brokerage business?
You gotta, look, in finance, insider trading, you go to jail for. In real estate, that's the game. So half of the knowledge you acquire from being a broker is just by talking to people. Like we're having this conversation right now. I've already learned some things, from you. And, eventually you get enough of those inputs, you start figuring things out. And you get a lot of access and touch points to a lot of different types of deals. But I'm still up, 8, 9, 10 p.m. at night trying to figure out, like last night, for instance, I'm a little foggy because we're selling a deal with brownfield tax credits, and I'm really getting into the weeds of exactly how the benefit's going to work, what the benefit's going to be. Are these tax credits actual money received, or they just come off your taxable income? And this is something I don't know 100% of, but I'm more educated about it, today than I was yesterday. And, that's a big part of the development site in Brooklyn right now is if you can get these brownfield tax credits back, it's money. So, I think it's just being curious and, kind of getting through the day-to-day without getting sidetracked. But then at night and on the weekends, I still have a list of things that came up during the week that I didn't know or I don't have mastery over. And I wake up in the morning, I go get the coffee, I get the Google out and try to, figure out what I didn't know that week. And that process has still been going on. I'm 37 and, it's still no different than when I was 22, 23. The list is just a little bit shorter, but, in the beginning of brokerage, you're kind of pretending your way through it and you're meeting with people as long as you can kind of get by, show confidence, but get by through the meeting. But, if I just used to write down like everything that even terminology, someone say treble damages. I'm like, what is that? I'd have to go research it. So, still learning, definitely, it's an exciting sport, but I think just being curious and then putting in those extra hours to figure out what you don't know and repeat that cycle is where you get to the specialized nature of things.
You're really mastering the brokerage business.
Yeah, I mean, it's fortunate. Some people work in a product type that they don't invest in, but this is like the best business because every piece of knowledge you can then use, to your own advantage in your own personal book at some point. So there's like a double-edged sword to accumulating knowledge, of all kinds, which even in the space that I'm in the real estate market, in the $100 million and under basically market, I feel like I'm more fortunate in that sense than I would be if I was just working institutional deals, because me as a personal investor with my net worth, I'm not buying institutional deals.
Yeah.
So, I'm in the market of the private client market, and that's kind of, the realm that I'm in on a personal level too. So there's a double-edged sword to accumulating all this knowledge. I mean, it's
I could smell a broker developer transition coming down the line.
Yeah, maybe 10 years. I mean, it's nice being a broker because you don't lose the touch points. So, I like this vehicle I'm in right now. I think I just got to keep, driving in this vehicle for at least another 10 years. Maybe at 47, I'll switch things up. But, it is interesting when you just flip to the principal side, you do lose some touch points. I mean, you talk to other owners, but unless you have really good broker relationships, you can lose touch with value and what to look out for and, knowing who your customer that you're going to sell to is. So it is good to have your tentacles in the marketplace.
Well said.
Big benefit.
Well said. How big is the team right now? You're Marcus, right?
Yeah, Marcus Millichap. So I run the New York multifamily group, which is basically the largest multifamily team in New York City for Marcus Millichap, specialized $100 million and under, coverage in all of the boroughs except Staten Island, where there's just not a lot of activity, although probably somebody can make a killing. And our team is about 20 brokers total and 10 support staff. I think last year did somewhere in the low $20 million in revenue.
Got it. Gross commission, GCI.
Yeah, and we do about 100. It's been basically about 100 local transactions with another like 40 triple net and various outside market deals. So anywhere between 100 to 140 transactions closed per year, pretty consistently since 2015.
You guys ever do anything on the island?
Not personally. The company does.
I buy from them all the time.
Yeah, so I stick to what I know. Which is boroughs, multifamily, mixed use, development sites, anything where somebody can make money, but mostly geographically, oriented.
I saw a post on Traded a while back. You sold a project to one of my partners and good friends, Ariel Shalom.
Oh, of course. Yeah. We just signed another one with him this week.
Did you?
I'll keep the address secret, but a Greenpoint development site.
He was telling me about it.
Okay, good.
Last night. Yeah.
Yeah, it moved quick. I mean, there was a lot of competition. I'm glad he got it. He seems to get projects done. We sold him a real nice one on Lexington Avenue.
See how beautiful that project came out?
He did it really, really well. That seller was, this is like old school Brooklyn seller. I forget all the twists and turns, but this guy was like out to lunch.
Really?
Oh yeah. I'm glad we got it closed because it was like, are you all there together? Like, you didn't think the contract meant anything. He would call us every other day and be like, the deal's off. Like, we're like, what do you mean the deal's off? Like, you said a contract. He's like, I'm not selling. Deal's off. Tell him the deal's off. Like, you have his deposit. He's like, I don't know. And then the next day, when's he closing? Next day.
Is that like the old-fashioned Brooklyn mentality?
Oh, yeah. It's like they either just don't. Yeah, the real old school Brooklyn mentality is just, I don't care if we signed a piece of paper, yes, but there's plenty of ways we can both bicker about something in there, and at the end of the day, we'll both have to decide to close or not close.
Was there a retrade on that one?
No, just a long closing. Everyone likes to keep the game going as long as possible.
Just like that wedding analogy you hit me with earlier.
Yeah, it's nice to have all these gigantically long escrow agreements. So,
well, guys, by the way, Shaun's newly engaged.
thank you very much.
Congratulations,
we'll see how long
friend.
this escrow is. I'm the one trying to speed it up. I'm going to send her a TOE.
Are you?
Yeah, she's the one delaying things.
That was awesome. I saw you guys at the top of a mountain, right?
Yeah, I went to the Catskills, had a good little session. Fortunately, I some passerbys were there and were able to capture the moment because I was a little bit worried about that. But it was good. We've known each other for a long, long time, so it's definitely the most exciting thing happening in my life.
That's awesome. That's awesome. How do you balance work life? Because you're a very active broker.
Yeah, I don't. I think the whole like work life balance thing gets a interesting rap. Like for me, it's not 50-50 time. For me, it's like work-life balance is going extremely out of balance, but then going the other way. Meaning to say, like, I'd rather go 90-10 on work for like a 2 or 3 week sprint. And then like after this, I'm going to Hawaii for a week and I'm going to try to enjoy 90% of my time, for my life, my relationships and my health and everything else. So I'm not looking for like an equal parts day. I'm looking to go real heavy in one direction, and that's work, grind, and, not have any other life other than that. But then when I'm going to go on vacation, I'm going to try to like go the other way and really, heal. So I don't know. I think there's a time to press in certain directions in life and even in, market cycles. Today treasuries are down, so there's a lot more to do than there was on Monday.
Yeah.
So, it's important to, like I said, rest the brain at least one day of the week. But if you're looking for a 50-50 balanced lifestyle, I don't think real estate's for you. I mean, there's a time to press and there's a time to, to relax. You got to do both really, really well.
Big time.
Yeah.
Big time. Is your phone off the hook all the time?
I mean, I've recently learned that do not disturb can actually be really helpful for me, because the problem right now in general as a broker is the people that are sometimes trying to get to you all the time can distract you from what you need to accomplish. So, right now there's so many requests for BOVs coming in. It's just
What's a BOV?
Broker opinion of value. Like, what is my property worth? Like, here's the rent rules, get back to me. And those are coming in with a higher frequency than calls from buyers to looking to buy a deal. So I could spend all day long, all week long, just doing BOVs for people and prospecting for new business. But then how am I juggling actually selling the business that I have? So, right now, you also just have to focus on what's most probable. And, right now in the market, some of the people that we chased for 2 years to get the assignment of, or 4, it's no longer probable. Like, we have to have that tough conversation and, hey, look, interest rates are too high. NOI is not there, and be willing to focus on something more probable. So that I think is like the biggest challenge, right now for me personally, is figuring out what to spend time on and how to politely decline business so that I can focus on the business that's probable. So we're in a shifting market. Not everything can be sold.
Yeah. Every day the market's changing.
Mm-hmm.
I mean, I'm seeing unprecedented opportunity.
Yeah, and I think it's just, on the deals you're doing, are you having lenders kind of it almost seems like, lenders are changing terms on people and pulling proceeds, and that causes a lot of anxiety in the buying marketplace. Like, there's one thing, treasuries are down today, but does that translate immediately into actually lower interest rates in the real economy? Do the banks just, put a higher spread? And so I don't know, what you're seeing, but
oh yeah. I mean, we can see the treasuries coming down help us when we lock in a nice floor,
Mm-hmm.
So I've definitely gained some upside in locking in lower floors with my lenders, except they still retrade you,
Right.
because the uncertainty of the market is causing them to be more conservative, and they're retrading me on LTVs left and right.
Right. And so that becomes very like scary. Like in the last week, I've had probably $200,000 of commissions personally to me just drop out like one after the other. Like get an email, buyer gets to the end of the diving board, does one of those like into the diving board moments, looks around like, do I want to jump? And every single time this past week, too much uncertainty, bank not giving me like enough good feels to like proceed with the deal. And sometimes a deal has to die before it comes back alive, and that's okay. And as a broker, you kind of learn that. Like sometimes you just have to go to zero real quick in order for it to come back alive. And I think some of those might be resuscitated. But I mean, man, this is the first time in a while I can remember like lenders really just not being like solid on on their term sheets. And it makes sense why a buyer is pausing at the end of the diving board if they're not getting those relationships, or if their preferred lender, Signature, NYCB, are in the news and under receivership. I mean, that, there's a little bit of
a deal killer.
There's a little bit of an inertia right now, going into, the second quarter of 2023, just with, buyers like have to make a whole new lending relationship. They're like, I don't want to go through this. Like,
wow, you just hit the nail on the head. I was about to bring up that point. My new lenders are lenders I've never even heard of, never thought of tapping into.
Don't have your net worth statement, don't have your financials, don't know nothing about you. So like that, going through all those hurdles again, it might take longer than 60 to 90 days to begin with. It's not just, calling your lender up and saying, hey, order the appraisal, but they already have all your stuff. So that transition that we're going to have to go through right now is going to slow things even more. So as a broker right now, it's either like 30-day TOE, do you have the real money or not? Or we might have to like give you enough time to really like create that buffer where you don't feel like you have a gun to your head.
Yeah.
Knowing that like, hey, if Signature was your lender before and you need to go make a new relationship, it just might take a little bit longer to get through the chute. So we'll see how that plays out.
No, you're so connected to the market. It's crazy, because I think you're the first person that's mentioned that to me since I've been mentioning it to my team. I'm very active, so my finger's on the pulse at any given time. Our new lender relationships are a Japanese bank that set a footprint in Texas, and an Arkansas-based bank, small family office. Those are the ones closing.
Wow. Yeah, it's just like
I never thought those would be my lenders. I was with Flushing, I'm with NYCB, Suffolk Federal, all those community
How
banks.
did you find those lenders? Through a mortgage broker, just like in the pulse of the market, them finding these new banks that are out there?
Yeah, these debt brokers definitely also have their fingers on the pulse, because otherwise they're not making any money.
Yeah, it seems like a really good opportunity for somebody to come in. I mean, it'll be interesting to see what happens with Signature's multifamily loan books. Who does it get sold to, at what price? Hopefully it gets sold cheap, because then it just allows more opportunity for some profit taking along the way. I mean, we'll see what happens. But I remember when I started, and I think for the most part Signature's book is great, but I'm sure just in like any book, there's some properties that are distressed in it. But when I started in 2008, 2009, and I didn't know really much of anything there, but JP Morgan had bought WAMU, and there was a lot of crazy WAMU loans. But basically all the borrowers just bought back their own loans at 30, 40 cents in the dollar. And that was when there was no liquidity. And I remember at the time being like, man, no one ever loses. Like they, refi to the bones and then buy their own debt back from the bank once it gets in trouble.
WAMU's Washington Mutual, by the way.
Yes. So, I think I had read at the time that, JP Morgan Chase bought WAMU's portfolio for like 10 cents on the dollar or something. So they could sell that book that they bought at 10, exactly, and make profits. So
I know a guy that did about $800 million in those loan buybacks to himself.
Wow.
You might know who the family is. I cannot say their name, because then a hitman would be after me.
Right.
But yeah, they made a fortune.
Right. And I think this one will be different just because there's still plenty of liquidity. Then there was just nothing, around. But it'll be interesting because there's a lot of, like just technical defaults if we want to look into all these loan docs, that if people start selling paper to, the venture funds that just want to find some technical default in the loan doc and start.
But the liquidity is off the charts now.
Correct. So there's still a lot of money around, although I also think we're at one of these inflection points where me as a broker, we're figuring out like who's got real liquidity and not. Because, 6 months ago, everyone's got all these cash reserves, but now you're starting to realize, well, half of the cash I have in cash needs to go to being defensive and paying down loans and resizing things. So you can't be aggressive with all of your cash, and you're starting to see like people have that realization. So it's how to play defense and offense at the same time, which is a really challenging thing right now when certain loans come up and they need to be paid down, but you also want to take advantage of opportunities of elevated cap rates, and cap rates are elevated. It's like we have actual properly underwritten 7% cap rates in New York City. Like that has not happened since 2010, 2012.
Yeah.
So to me, all signals are buy signals outside of, you know, some political risk in New York City, but you know, the opportunity is here to buy a high cap rate, whether it's, you know, super positive leverage with higher interest rates, so be it. But I'd rather buy a high cap rate in general than a low cap rate, even with a better spread.
Yeah. I think you'd appreciate. I picked up a building in Midwood.
Oh, nice.
Yep.
What kind of building?
Mixed use.
Okay.
Retail at the base.
Okay.
And 2 apartments upstairs with another 6,000 square feet of air rights.
Okay. Will you build on it or just use the existing
Just
structure?
renovated,
Yep.
existing structure, tax class protected.
Mm-hmm. What kind of cap on cost do you think you'll build into there?
Build, I have no idea. But I went in at like a 6.5, and
Okay.
I'm bringing it up to an 8.5.
Okay, so that's what I meant. Like, you know, stabilized NOI, cap on cost,
8.5,
so 8.5. Yeah, so that's ridiculous. You'll refile your money out, it'll be a free building.
Yep, I did that with Ariel,
Okay. Oh, nice.
and we got rid of the first floor tenant, so we're releasing it right now. I didn't know you guys do leasing.
We don't do any leasing.
Okay.
Marcus Millichap as a company doesn't do any leasing, just the sale of investment properties. So we even sell marinas, but we don't do any leasing. Anything with an investment grade purpose. It's actually really exciting. So we do this company trip next week in Hawaii, where I think Marcus does better than any other. I think they would have to be in the top 10 of any awards trip for any like S&P 500 company, really. So if you hit a certain level, I think there's maybe 300 qualifiers, all expenses paid, first class to a 4 Seasons resort. You get to bring a significant other. And, you know, there's like 300 people that I basically go on vacation with every single year. And it's real sick too. Like they, you know, just in true Machiavellian sense, like, you know, you go to the awards dinners and like, you know that the people to the left of you made more money than you, and the people to the right of you made more money than. Like it just is like an ego trip, but
That's
awesome.
awesome.
All expenses paid, like basically like adult spring break / like business development week, where, you know, I get to just interact with all my colleagues from Texas. You know, we have offices in Canada, and just really have these kind of conversations, you know, over, you know, a pool or dinner, and that's really fascinating. I'm really excited to go to that, because it's like the inputs and the information you gather from just talking to all these cowboys and cowgirl brokers that are all dominating their space across the country is really, I just pick up a lot of information. So I'm super pumped for that.
Now, that's one of the upsides of Marcus.
Correct.
And there's others, of course.
Mm-hmm.
But what's the downside of being at Marcus?
I mean, interesting question. I think a lot of I think like whenever you look sideways, that's where your income goes. So I don't spend a lot of time like thinking about like where would a better opportunity be. I'm pretty happy with all the tools and resources that happen at Marcus and Millichap. Of course, you give a certain percentage of your, you know, commission away, but to me, it's a worthy trade. I want to focus on selling apartment buildings and getting to the finish line. I don't really want to spend time like making an HR policy and processing accounting and worried about liability of this and that. So to me, when I add all those things up and it allows me to just do what I do well, it's worth the toll. Not to mention the relationships and the support, and just, you know, I've been with the, you know, company 14 years, which is crazy to even say, and I might be there another, you know, 14 years. It doesn't even dawn on my, you know, mind to leave. And if I was going to go, you know, do something on my own, it would have to be like a national type of play. I wouldn't want to start a boutique, you know, kind of brokerage, because I just don't think the resellability of it is enough to warrant the risk. I'd rather just use additional discretionary capital that I have to, you know, buy properties and create, you know, that vehicle than dump it into a brokerage firm, unless I had a national vision.
Which makes total sense.
Mm-hmm. Yeah, you got to pick your spots.
And anytime you take away right now from what you're doing, you're giving up selling a building to another Hasidic Jew in the Brooklyn.
100%. Yeah, I'm like, you know, when people interview, like, what do you do? I'm like, well, I'm basically just a Jewish matchmaker.
Yeah,
you know, I'm just
that's
like,
it.
You know, I'm not Jewish. I'm a Gentile, but like, I get it. You know, you're just mixing and matching. Somebody.
The first question, are you Jewish? Right?
Yeah, exactly. I think I'm gonna start observing Shabbat. I think that's a really good tradition. See, for us Gentiles, when we like try to ask our friends over for dinner on a Friday night, it's like a big thing. It's like a to-do. It's like, I don't know if I can do that. You know, establishing just a practice of that, I think, is an amazing part of the culture.
The Jews are at it again.
Yeah.
The brilliant ideas.
Yes, absolutely.
You must work a ton with the Hasidic community.
Yeah, those are my best client base. I would say the Orthodox Southside Williamsburg group is probably my number one client base. And they're all business, and, you know, it is a real game. I would say second to that is, you know, the Great Neck crowd.
Oh, really?
Oh, yeah, for sure.
Oh, interesting.
Yeah.
I thought the Bukharian crowd, like Queens, would be one of those bigger players.
Yeah, I mean, you know, again, we're selling properties to every different type, but on speed dial for me is most of the Southside Williamsburg guys in particular.
Interesting. They're active, all cash, fast.
They make quick decisions, and, you know, like, there's a lot of shady characters in real estate in every different type of buyer group, but the ones in those buyer groups that are the real deal are the real deal. You know, like, they're not messing around. They're making things happen every day. And, you know, I just think when there's a lot of people like topically look at deals and like, will kind of like get to second base and then just stop there. You know, the real buyers, the real sharks in the market, they'll round the bases in like 48 to 72 hours. You know, they won't stop at second to like look around. It's like, let's get all the way on a Monday to a Friday to a fully executed signed contract, no matter how complex it is. I'm going to stop everything I'm doing. I'm going to push everything else to the side and focus on this one task at hand. And that's, you know, that's how you got to be a buyer in New York City. You've got to be willing to turn everything else off and just get something done. And this is one of those times right now.
Back to what we were talking about. Where do you see the most opportunity in the New York City space right now?
Well,
Real estate.
Yeah, no, I think one, elevated cap rates are elevated cap rates, so you can probably like throw a dart at the wall right now and be an active buyer in the next 12 months and probably look pretty well. Like in every 10-year period, there seems to be, you know, 2 or 3 really good years to buy and 2 or 3 really good years to sell. I think this is definitely one of those really good years to be a buyer. Just, again, because elevated cap rates is a function of interest rates and everything else. Interest rates go down, you look like a genius. You know, maybe that happens sooner than people think. Who knows? But as far as, like, what's the best contrarian trade in New York City, you know, what's the most, you know, guaranteed long-term success, I think it's finally, dare I say, rent-stabilized housing. And the prices are now starting to reflect the lack of upside, and it's kind of like we're so far from what used to be that people are starting to forget what used to be. And what I mean by that is, you know, for a long time you had sellers holding on because they remembered 17 times GRM and 15 times gross and, you know, 3 caps on rent regulated trades when there was an upside and ability. And now we've seen this steady decline of rent multiple from, you know, 15 to 10 to 9 to we should be signing like 150 units today at 8 times rent roll. And I think once you are now getting to these rent multiples, the buildings can actually pay for themselves out of cash flow, and you're not really buying upside, but there still is an intrinsic value to buying something with artificially constrained rents. And even if you can just, you know, grow the top line gross revenue by RGB by, you know, 3 to 5% every year, hopefully we get a solid 1-year increase this next cycle. I think we're just now at the price point where if the laws change, you're really in the positive. But
what's RGB?
Rent Guidelines Board.
Got it.
So that monitors, you know, how much you're allowed to, annually increase the rent. And we're just starting to see, and I've actually heard this from a lot of, like, anecdotally, just from a lot of my colleagues that are all saying the same thing, because we are starting to see also some people that have not been buyers since 2010 to 2013 buying and making offers on regulated housing.
Wow.
And I think it's a lot of it just seeing that GRM come down. I mean, we start to see, when I started, it was like 70,000 units, 7 times rent roll, when there was no financing whatsoever available. And now that you're starting to see that roller coaster ride come down, where, you know, big multifamily offerings, 100 units, maybe $1,400 average rent, where the market rent would be $2,300. So you have like a $700, you know, delta that's just an implied upside if the unit was just, turned over and they changed the laws, you can model out steady eddy increases. The key is like, can you underwrite the expenses correctly? But on a property that's, I think 8 times is really like the liquid market right now. I think that it might not be the bottom, but it's pretty close enough to the bottom where all the downside can be priced in and there's still a ton of upside. So,
wow.
It's like what's in a supply constrained market, currently out of fashion, not in vogue, and, severely under market and below replacement costs, rent regulated housing. And I just think if you can buy like a, 40 unit rent regulated property in Prospect Heights with average rents 50% of market at a going in, 5.5%, 6% cap rate, I think those are buys. And I think people are starting to now realize it. And again, just the type of customer that's coming back and bidding on these all of a sudden, these are the people that like don't make mistakes. And like you're just starting to pick up on, oh, you're back? Like, what do you know? And, what do you know that no one else knows? And it might not be that the laws are going to change. It's just like, it can't get too much worse than this. And at these metrics from somebody that's been in the game of New York City regulated housing for 30, 40 years, you're starting to see GRMs, gross rent multiples, that you haven't seen in a long time. So I think that's the move.
I am not well educated in this space at all.
Mm-hmm.
So I'm going to ask you some questions that might
Sure.
seem simple in fashion, but I'm assuming many people don't know. In these rent stabilized properties, are the taxes also under control, or could those change dramatically?
So 2 different buckets. So in tax class 2, which is the larger buildings, they're based upon real property income and expenses. So they do go up and down. And, when I'm not wearing my broker hat, like if you underwrite to 25, usually 25% of the gross income is where like the top watermark is, that's generally the most that those taxes should be. So if you're buying a building at 8 times rent multiple where the taxes are already 25 to 30%, you shouldn't have any more downside risk of the taxes going up.
Do they reassess upon a sale?
No, they reassess every year on September based upon the income that you send into the city. So it's based upon RPIE, real property income and expense report. So it is kind of somewhat logical, how they assess properties. And again, there is some like vacillation, but the worst case is usually 25, maybe 30% in the city in Manhattan of the gross income. So you could take,
and that's tax class 2.
That's tax class 2. Tax
Not
class
2B, not
2B is capped basically. That's basically what you refer to as a rent stabilized tax bill. It can only go up 8% year over year, and it's starting from usually a generally low base. So
8%.
8% year over year, or no more than 30% over a 5-year period. But if we're talking about a real estate tax bill, that's only $10,000 a year, right? 8% is going to go up, marginally, a lot less than your top line gross revenue could be. So it's pretty crazy because, you can have a 16-unit building with a $300,000 gross rent roll that has a $100,000 tax bill, and you can have a 10-unit building with a $300,000 rent roll that has a $10,000 tax bill. And, that's why some of these smaller buildings are selling for way more money in nominal dollars than a much larger building.
Makes sense.
It's just because the tax treatment's a lot
What is
different.
tax class 2A?
It's also tax class protected. It just 2A is when the retail is over a certain percentage of the overall gross square footage of the property. So that's why you have all these institutions chasing the protected tax class buildings, because they can control their expenses, i.e. real estate tax is the biggest uncontrollable, and keep growing income. And that's why you see Carlisle and a lot of these, it's hard to scale. It's still a building, still requires a boiler and a super. So it is better to have more units in one place. But again, that tax treatment is much different. What you should avoid basically is what I'm saying is, I think a 60-unit rent-regulated building with $1,500 average rents and taxes already at 30% of income is a great buy. That same building where the taxes may not have caught up yet, or maybe the guy's not filing perfect RPIEs because he's trying to keep the taxes low, and it's only 10% of the gross income, that's the one that you're going to lose money on, because your NOI is just going to go down as they start to slowly rise the taxes on you.
I see.
So it's just always interesting. People are like, the taxes are too high. I'm like, that's the point. That's why it's a good deal. They're not going to go up anymore.
I see.
Like,
Wow.
It's a they're two sides of the same coin. So anyway, I think all the downside is almost priced in. And again, it might go a little bit further lower, but you can't freeze revenue on anything. Eventually it's going to break, and they're going to have to start unleashing these vacant apartments and giving a market rate reset. I mean, there's 60,000 vacant apartments that are just boarded up in New York City right now. Like, eventually a politician's going to run on that platform of unleashing these units to the market. And I mean, can you imagine what rents would do if 50,000 apartments 3 months from now, as these units are all renovated, come to market? Rents would go down.
Yeah.
This is what the people want. So it just eventually logic is going to come to city council and, the legislators, but it might just take another year or two.
Or a decade.
I mean, this is the bet, right? If you get that bet wrong, you're going to be wrong. But if you get it right and you're kind of, buying a good property where all you got to do is make the tenants happy, and again, if it can cover itself on its own merit and you're not pricing in the upside, if it's a real 6 to 7% cash on cash return with all these artificially low rents, and then they change the laws, you're going to be sitting pretty, because immediately, if they change the upside mechanism, the cap rates go down.
Yes.
So for me, personally, this is what I've been investing into on the side in New York City, is that type of genre. And right now, if that's the type of deal I would love to see, is a nice, in a good location, below market rents, and I would try to actually lock in 10-year financing, because right now 10-year money is pretty cheap.
Yeah.
And if you just want to marry the thing, which most properties that I would like to buy, I'd like to own for a long time anyway. I don't need to necessarily refinance them in 2 or 3 years. Lock in this 10-year money. 10-year money is cheaper than 2-year money.
Yeah. Have you ever sold a deal, or do you know Adida? Albanians?
No.
Adida Gonaj, I think his name is.
Bronx guys?
Yeah.
I don't do too much in the Bronx, so
Bronx
Seth
guys.
Glasser, my partner, would probably know them.
Oh, Seth is your partner?
Yep.
Sends me emails every day.
Oh, does he?
Yeah. He's got a lot of those retail buildings, 2-story retail buildings.
Sell anything. No, Seth and I talk every day. Me, Seth,
Oh,
Joe
wow.
Costa, and Mike Silvatico were the...
Are you guys all partners?
Yeah.
I think Seth has been trying to get a hold of me.
What should call him after we end up in this podcast?
He had this building that I was in the running for in Queens.
Okay.
Does he do Queens?
I mean, we're working a couple Queens deals together.
A medical building?
No. I don't know about that.
And nice guy.
Anytime you need a little bit of an edge from a Marcus Millichap, broker, just call me.
Awesome.
I'll put in a good word.
Awesome. I will. Yeah, in Long Island, I'm very active with them. Actually, I went into contract this morning on a Marcus deal.
Oh, yeah?
Mixed use, 5 apartments, 2 stores.
Out in Long Island.
Long Island.
Awesome.
Eastern Suffolk deal.
Wow.
Where the taxes are extremely low.
The taxes are low. 'Cause I hear usually they're high out here.
Nassau County has very high taxes.
Okay.
Suffolk County has very low taxes.
Right. It's just like my Montauk houses. The taxes are nothing. I'm like, this is great.
Yeah.
Yep.
There's
8,000.
Yeah. Cheap.
Yeah, nothing. I guess
And you have a lot of land.
Right. So,
Montauk's on fire.
yeah, I mean, to me, the math really worked on these single family rentals. I had sold a couple apartment buildings that I'd owned with some partners, but the debt at that time was the asset in of itself. So when you're taking 10-year interest-only financing at 3%, I basically could cover the entire debt service with 1 month of rental.
Yeah.
It's July rent pays for the entire mortgage. So that math doesn't work anymore. I'm hoping, prices were going to come down, but they haven't, just because there's always some industry. I think Seth Weissman said this. There's always some industry in the world that's making a lot of money, and they're all buying in these very expensive markets, Aspen, Vail, Montauk, Hamptons. So in that sense, it's this stuff's never going to go down.
Oh, I was talking to a family here in Long Island that they have massive operation, very successful manufacturers. And yeah, we bought a mid-rise in Manhattan. And they looked at the numbers, and I'm like, this makes no financial sense.
Mm-hmm.
And they're like, what else are we going to do with the money?
Right.
I'm like, okay, well, now it makes sense, right?
Mm-hmm.
These families from across the world see Manhattan as a haven, and they just park their money in these buildings that to an investor just can't do it.
Correct. You're not going to syndicate it a 3.5 cap elevator building in Gramercy.
Yeah.
But if you're managing a portfolio and just want something safe and
you have nowhere else to put your money.
Up until now, you didn't have anywhere else to put your money. What's crazy about the current market is cash is actually making a return. You make 4.5% risk free.
Yeah, but there's no tax advantages to that.
Correct. But you can, you do a little bit of both. But it's just interesting because we're now competing with alternative investments that
crazy.
Just sitting with cash in the bank makes 4.5%. So for me, it's like what I know intuitively is it's got to be at least double the risk-free rate to go, beat your head against the wall trying to, get a loan, close a building, work with tenants, fix this, fix that. So we'll see. I mean, cash will probably, the cash returns will probably just come down, and then people will get more motivated to make acquisitions again.
I think you'll appreciate this. What you just described has caused me to ramp up our out-of-state acquisitions, because out-of-state, it's like much easier to navigate the rents and driving rents up and everything. They're much more red states, right? But then it's like flipping a coin every day. It's like, but then prices just tanked locally. It's like, all right, now we're coming back to Long Island. Now go explain that to your investors.
Right.
They're like, but 2 months ago you were ramping up in Houston.
Right.
Why are you just now coming back to Long Island?
When you say the prices, you mean just like basically the mark-to-market valuation, just because interest rates have risen and someone to buy that, 250 unit just wants a higher cap rate, but the rents are still going up.
In Long Island?
No, is that what you're seeing in Texas? Are the rents still going up?
I see them at a standstill
They're
right
plateauing.
now.
Yeah, got ya.
No question.
Yeah.
But in Long Island, it's it's like Brooklyn. You could take an apartment, renovate. You're going from say 1,500 to 3,500, right? In Long Island, you could take it from 1,500 to say 2,500. And you can't touch the 35, but you're still seeing massive upside. In Houston, Arkansas, St. Louis, all these national markets, tertiary markets, you're taking the rent from 1,500 to 1,600.
Right.
No matter what you put into it.
Right.
So,
and maybe I think at the end of the day, it's still like if you're buying a market that you believe in, because sometimes rents don't always just like go like steadily up. They plateau and then they make a big jump and then they plateau again. So, some of it might just be, as you're seeing like rents plateau, it's because a lot of people have been buying and doing the exact same thing. So you're competing now with a lot of people that renovated units, and now there's like enough supply where the prices are plateauing. But then as people perceive them to be plateauing, they stop doing all those renovations again. And again, like 2 or 3 years later, you might hit another just like big jump up to a new plateau.
Yeah.
And if you're buying good locations, that's that whole supply demand imbalance. Like it always works itself out over time. If you're buying a good location that overall of a 10-year period just has more inbound than outbound.
Or when your broker hat comes off, it might come down.
Correct.
It might not this plateau might be leading to a downturn.
Yeah, I guess you never think about anything going down, but that's where you got to, pick the location right and, know where the demographics are. But yeah, I think look, again, New York City cap rates are, from what I can tell, and I'll know at the end of next week when I go ask this question from every one of my colleagues at Marcus Millichap, what are the cap rates? I think New York City cap rates on paper are higher than most other places in the country, the Sun Belt and everything else. So in that sense, it's, come back to New York City and buy a 6 cap.
Well, there it is.
Yeah.
I'm coming back to Long Island and I'm getting these value add 8.5s. It's a difficult time. It's difficult to explain it all the time to your partners, your capital partners, because they look at you from a different lens, especially when you're younger. They're like, oh, maybe you're not so attached to it. Maybe you just haven't been through a down cycle. You don't understand. And meanwhile, my youth is getting me excited, right? Like, you guys don't see what I'm seeing. I feel it. I see it. It's, Signature went under. A woman's loan ballooned. Her rate is 400 above SOFR. She wants to sell now. It's changing so fast. You got to get I believe the good operators, the good investors, the great ones are going to have that capital follow them on whatever quick decisions they're making.
Correct. Yeah, you definitely have to be willing to pivot. I mean, right now, like you said, you just think like all these loans, like the debt yield used to be like 7%. So like now cap rate is 7%. So you're basically buying it at the loan amount or right above the loan amount. If interest rates go down, you have a full cash out refinance. That's why they were able to refinance that in the first place. So it's just going to be an opportunity. There might be more cash in, 50% down on some of this New York City stuff, again, because the positive leverage isn't there, but you're still buying elevated cap rates. More cash in right now, but then it'll be more cash out if interest rates drop on the refinance. So I think
they should.
Absolutely.
Even if they continue to climb.
We just saw where it broke the system. So, I don't know if they're going to push past that level again.
Well said.
They did the 25 basis points, but it's like they clearly know where, okay, we were just going to keep pressing until things broke, and now things broke, and hopefully we don't have another run on another regional bank, which would really set things off. But I I definitely think we might have seen the high water mark of where rates are in the short term because,
Are your sellers scared? Your sellers.
Yeah.
They are. You could clearly see
Yeah, I
the
think,
change.
I mean, if you have debt due this year, if you have any balloons due this year, you're trying to figure out every different situation possible. And we're getting a lot of BOV requests. And even from a probability standpoint, I'm quickly sizing them up before we even like do a pitch. Like, is this property worth 10% above the loan amount? Because from a broker, as soon as it goes under the loan amount, it's a whole different workout. It's like a 6 to 12 month process. So, if for a sale to be made, I mean, I'm generally hoping that there's at least a 10% VIG on top of the loan amount to pay for transfer tax, our fee, all the miscellaneous items that come out. But a lot of the notes that are due are either going to have to be paid down, or if the bank allows them to just roll into the option period, the new interest rate is going to be 6.75%
On a good day.
And now you're at best cash flow neutral, but probably seriously cutting a check every single month to feed it. And
See,
again,
the Marcus boys are calling me in Long Island because I'm so active with them, and they consider me a great buyer. They keep calling me. But they're basically just spelling that out. Alon, loan's coming due. It's going to 7.5. Seller wants out. Here's the strike. It's like so much more simple than it's been over the last 5 years.
Correct. And you almost have to disclose this to even get a buyer attention. It's like we used to just like hide and conceal all these things, but one, it's kind of public record, and two, it's the only way you get somebody to make a bid because they want to know that there's a real seller. And then you just have to make the decision, is this still worth like on its own merits? But yeah, you have a lot of debt that just has to be recycled globally. Like, we'll see what happens. I mean, again, the only thing that'll save the day is if treasuries go down enough and all of a sudden like people are kind of able to refinance and pay down a little bit. But, I mean, you're talking about some loans that could have to be paid down millions. It's very difficult going to the whole partner conversation, especially if you've owned a building. Just looked at a portfolio. Guy built up a portfolio between like 2010, 2014. They already refinanced all the money out. So like they're in the clear, but now they've owned it for this portfolio for 10 years. And now it's going in reverse. They have to refinance again, but this time they have to like come out of pocket and pay it down. It's been 10 years. Like, do we really want to do that? Like, it's hard to call up partners that maybe not in your current deals that are, it's 10, 12-year-old vintage stuff to go say, hey, I need to.
Bob Knackle touched on this when he was on the podcast.
They'd rather just sell and just clean the books, right? It makes more sense than to have to go through that whole mental exercise, especially if these people are not, in your new, ventures and everything else.
And what happens when they don't want to put the money?
Yeah,
and they start fighting you and looping in their litigators. Then you have a mess on your hands that you never saw coming for a decade.
Correct. And it's just an easier out to sell, which is a good thing from a broker's standpoint, because it's like the inertia or the obstacle of just selling is sometimes easier than trying to dilute somebody's shares and do it, and, and renegotiate operating agreements. So I think there's actually going to be a lot more broker transactions the second half of this year. This last 6 months has been nothing but friction. But I think all these situations are playing out. And I think people rather just sell and start new than pay down loans in general. So, I mean, this is, again, buy opportunity. If you have cash, this is when, you got to be out there and making offers and being vocal and not trying to time the exact bottom, but just buying, So I think that's always the hard part too. It's like, you got to be comfortable that this might go a little bit further down, but it's okay. It's like, you're not going to time the absolute bottom.
Well, I hope you make a ton of money in this market. You're an awesome guy. I'm so happy you came on the show. Where can everyone find you if they want to touch base with you or just get to know who Shaun Riney is?
I'm very active on Instagram, LinkedIn, Shaun Riney 1. I keep my personal name separate, or 718-475-4369. Phone call is always the best.
There it is. Shaun, thanks so much for coming on the show.
Appreciate it, Lon.